I'm a Star Trek fan. I don't know if there's anybody else that's a Star Trek fan, but in Star Trek, they had these rules for how, when they go out into space and they meet new civilizations, how they had these rules for how to interact with these other civilizations, and it was called the Prime Directive. Well, this is my Prime Directive right here. This is the sheet that everything is distilled down to one sheet. And I'll give you an example. Right here, risk, reward, and probability. These three ingredients will always be in balance with one another. An example would be a T-bill. A T-bill has a tremendous amount of risk compared to the reward. I'll give you an example. If you buy a T-bill for 3 months, you'll put up $100,000 to make $250,000. You're risking $100,000. Now, what's the probability that you're going to lose the $100,000? Infinitesimally small. In fact, the U.S. T-bill is the best investment on the planet. So for an investment perspective, it has the highest probability of profit of any investment out there. But you are risking $100,000. It's just unlikely the U.S. government's going to default on its debt in 3 months. Some people might disagree with that, but it's unlikely. At the other end of the spectrum, at the complete opposite end of the spectrum, if it was just think about this, if risk and reward was the only criteria that mattered, shouldn't we all be buying lottery tickets? I mean, forget these jackpot games up there, just go out and buy a Powerball or something like that. But it's not a good investment, and the reason is the probability. What's the probability of having the winning ticket? And it's infinitesimally small. So that's two extreme examples. And what we're going to do is we're going to try and find the right balance between risk and reward and probability. The next thing we're going to do is we're going to realize that what we are trading is not a stock. It's not a futures contract. It's an option. With the stock, the only thing that matters is the direction. If you buy a stock at 50 and it goes to 51, you make money. If you buy a call option with a 50 strike price and it goes to 51, are you going to make money? Who knows? If it goes, it depends on what you paid for the thing. It depends on if it makes that move within your expiration date. All these things, you're talking about duration and magnitude, which are critical elements. And then finally, well, not finally, the next thing is every trade that we make, we're going to actually apply a business analysis method to each and every trade. We're going to look for an opportunity. We're going to select a strategy to exploit the opportunity. We're going to determine what's the right price to pay to implement the strategy. And then we're going to have an exit strategy. So we're going to apply a business analysis method to every trade that we take. And finally, it's unbelievable that I actually have to say this, but I want everybody to realize that you've got to know what it is that you're trading. Now, how many people have traded an option, a stock option? Raise your hand if you've traded a stock option. So most of you have traded. How many people have read Characteristics and Risks of Standardized Options? Well, let's put it this way. Just to get an account open, you have to sign a document that says not only have you read it from cover to cover, but you understand everything that's stated in there. And that's before you get your account even open. Now, how many people have read it from cover to cover and understand everything in there. Yeah, y'all are a bunch of liars. I'm just kidding. What we will do is I want you to know how important. There's one section that I can't emphasize enough. I think it's section 10, called Principal Risks of Options. And that actually gives you the risks that are involved. And that is so, so important that you understand that. Because if you don't understand that, if you don't know what it is that you're trading, you can end up buying a put and think that your risk is entirely limited and end up with the short position in the stock, which has unlimited risk, right? So how many people, some of you may realize this by now, but not that many people understand that when you buy an option, if you don't handle the close of that position, that even if you buy an option, you can end up with an unlimited risk position in the stock, whether you want to or not. So we'll go over that when we talk about calls and puts.